Welcome back. Today I'm going to take an extract from my book Hacks for Life and Career, a Millennial's Guide to Making It Big, and talk about personal finance. What should be the right portfolio allocation statement for someone like you? Now, like I mentioned in my earlier videos also, personal finance is not given as much importance as it should be, whether it's an education system or our places of work. So why does personal finance matter so much? Especially it matters given the uncertainty that is going around, the economic gloom expected over the next 1 or 2 years, and the fact that many millennials will take up unconventional career choices. So the more money you have in the bank, the better you will sleep at night. So in this video, I'm going to talk about what should be the right allocation amongst various instruments from the monthly salary, you can say. Now, before we go on to the actual allocation that should be made from your monthly salary, it is important to understand that investment philosophies itself have changed over the last 2 years. Now, conventional wisdom used to be that equity markets beat inflation over a period of time, and over a period of long term would be 5 to 7 years, and hence you should invest 100 minus your age. If your age is 20, about 80% of your savings in the equity markets. Now, this notion has got heavily challenged because equity markets, the long term for you to see benefit is no longer 5 to 7 years, but it's now 10 to 12 years. Over that, the economic situation is fairly gloomy over the next 2-3 years, and the share markets nearly reflect the economic situation of a country. So the outlook of the equity markets right now is not that great. So that's one big change that has happened in terms of investing philosophies. The second change that has happened is people always used to say if you were younger, if you were in your 20s, if you were in your 30s, you should take more risk and explore aggressive instruments. But given the uncertainty around, given each individual's career aspirations do not follow a 3-decade-long career path, but to do what they really want to do, this kind of risk-taking ability has gone down significantly. And hence, if you look at an actual allocation, the guiding principles are as follows. 1, you need to preserve capital as much as possible given the uncertainty around. 2, there should be growth, but at minimal risk, given that 3-decade-long careers are no longer true and people will take interim breaks and do what they want to do. And 3, there should be sensible diversification so that your capital is fairly protected. Now, as part of the monthly allocation, I will first touch upon some of the mistakes people make with respect to the monthly allocation. And the first mistake people make is in terms of living on credit card debt. Now, as most of us tend to be fairly consumerist in our outlook, and when you see the latest iPhone or when you see the latest Gucci bag and then you see credit card charging only 2% for that loan, it becomes a very compelling proposition. But this is the worst form of mistake someone can make, is actually buying on credit card debt. The reason is because not only is it expensive, it accounts for 24% a year annual interest charge. The bigger issue is it creates a huge vicious negative mindset of living on borrowed money and spending on borrowed money, and hence they should be avoided at all costs. The second big mistake that is typically made, and all of us have made during our growing up years, is first to spend on the items we want to spend, the consumerist items, the lifestyle items, and the daily use items, and then save what is remaining. I think that philosophy is completely wrong. What is necessary for people is you save 50% of your salary, no matter how big or how small of your salary is. Save 50%, and the remaining 50% you live off it and spend on it. The third big mistake all of us have made is not to have an emergency fund. An emergency fund of about 6 to 9 months of expenses, say about 2.5 lakh rupees parked away in a neat deposit. So why do you need an emergency fund? You need an emergency fund because someone in the family might fall sick given what is happening. You might lose your job. So you need a fund of 2.5 lakhs to see you through over the next few months. Now, coming to the allocation, say your monthly salary is 100 and you have decided to save 50 of the 100. I believe the 50 should be broadly split among 3 asset classes. It should be split between debt, equity, and gold. So of the 50, you should have about 60% in debt. So 30 of the 50 in debt. The remaining 20 of the 50 you should split between equity. So 15 of the 50 in equity and about 5 of the 50 in gold. So debt about 30 on 50, equity about 15 on 50, and gold about 5 on 50. Now let's go one by one. So let's pick debt, which is say 30 out of 50 where you should invest. You should look at 2 broad asset classes within debt. One is fairly guaranteed returns with minimal risk. And the second asset class you should look at is in terms of quality debt with decent returns and minimal risk. So the first one is fairly fixed returns with minimal risk, largely backed by the government of India in some cases. So the Public Provident Fund, the Provident Fund, the Voluntary Provident Fund, the Kisan Vikas Patra, the fixed deposits by bank. So about 30 or the 50, about half of it, the 15 of the 30, you should be putting in these debt instruments. The second asset class within debt I spoke about is quality debt, fairly fixed returns, but there is a good guarantee that it will not be defaulting. So two sets of mutual funds you can look at. One is mutual funds that deal with corporate AAA paper, highest quality debt paper. And the second you can look at is mutual funds that deal with paper issued by PSU banks, because when it's issued by PSU banks, it's automatically sort of backed by the government of India. So this is in terms of debt. In terms of equity, where I spoke about 15 out of the 50 should be invested in equity, you should again look at two broad asset classes. One is the large cap mutual funds and the second is the American stock market. Now, when it comes to the large cap mutual funds, they largely reflect the GDP of the country, and there is very difficult to actually beat the index when it comes to large cap mutual funds. So you should buy a mutual fund which is a passive mutual fund, which means it just replicates the weights in the index like BSE or NSE, and the fund manager doesn't try to create extra alpha, as we call it. The second asset class you should look at is the American stock market. There are mutual funds that invest in the American stock market. The American stock markets have a very strong value proposition, especially after the American election, in terms of why you should invest in them. The third asset class is gold. Say about 5 out of the 50 which you should invest in gold, and you can invest in gold for the purpose of diversification. You can buy mutual funds that invest in gold. You can look at sovereign gold bond funds for the purpose of investing in gold. Now, at no point you should explore some of the instruments which you don't understand, whether it's bitcoins, whether it's financial derivatives, whether it's penny stocks, whether it's small cap. You should comfortably stay away from all of this and sleep well at night. So here's my take on what your monthly allocation statement should be. Do let me know what you thought of it. A detailed exercise of what I just spoke about is in my book, Hacks for Life and Career, a Millennial's Guide to Making It Big. So do pick that book up and get a lot more detail in terms of what I spoke about.